What's up everyone, it's Karthik with MoneyVest. So this is going to be your technical update on the S&P 500 before a start of a very critical week. We've got Nvidia earnings as well as the personal consumption expenditures or PCE numbers coming out next week, as well as the very important GDP numbers also scheduled for the upcoming week as well. So the markets are making a little bit of a double top, and we do have this market broadening out from other sectors. Other market participation is what's really carrying this markets higher. But if you take a look at the S&P 500 excluding Magnificent 7, that's actually outperforming the S&P 500 counterpart, very much indicating that there is more momentum in other parts of the market as opposed to technology, which has really lagged behind the equal weighted index. So as always, make sure that you drop a like and subscribe to the channel. We got lots to unpack and lots to break down in this video. So I would really appreciate you guys dropping a like and sharing this with your friends and family so we can continue to grow our channel and get to 100,000 subscribers by the end of this year. I would really appreciate that. And again, links to our Discord is going to be down below, Patreon with that 16% annual discount that does expire at the end of this month, and you can take advantage of that as well. Track and follow along with our journey. Access all the Discord and of course our options portfolio as well. So first things first, coming to what is expected of next week. So these are all the events. The more important ones are going to be the GDP numbers coming out on Thursday, August 29th. We do have jobless claims, of course. We have corporate profits, retail inventory, consumer confidence is going to be scheduled for Tuesday, and that's going to come out at 10 a.m. Eastern. And then we have Raphael Bostic is going to be talking on Wednesday. We do have a few other note auctions like the 5-year, the 2-year, and the 4-month bill, as well as MBA mortgage applications. And then finally, the most important catalyst for next week is going to be the personal income and outlays. In other words, the personal consumption expenditure, as well as the consumer sentiment scheduled for Friday, August 30th. So GDP numbers expected at around 2.8%. That is the consensus. That's exactly what I mentioned in my yesterday's video as well. And this right here is going to be the personal income and outlays, with personal income expected at 0.2%, PCE on a month-over-month basis at 0.2%, year-over-year at 2.6%, which is going to be a slight acceleration from the previous month's reading, and core PCE. This is exactly what the Federal Reserve cares about. This is probably the most important metric of inflation for the Federal Reserve, expected to also accelerate from 2.6 to 2.7%. So that right there is going to be the consensus for next week when it comes to inflation numbers, which is once again the Federal Reserve's preferred measure of inflation. It's not CPI, it's not PPI, it is PCE. It's just a little bit of a different way of calculating it and different weightings for the index as well. Now, this is where we are heading up to next week. It's really important to have a full bird's eye view and an overview of where we are with the MoneyVest dashboard. We are trading at well over 4 on the MoneyVest index. You can also see that on our trading view. So if you come over to this, you'll notice, if I just expand this over here, you'll notice that we are at just a little bit over 4. So 4 is the correct reading. Again, if you're rounding these numbers a little bit, I guess we come up to over 4.01. So that is the MoneyVest index, which again, historically, as you would already notice, is a level where it is in the red band, and also coming up to a level where we historically have been a little bit more unfavorable in terms of that risk and reward, something that we have again witnessed back in July, this right here back in March, this right here back in December, this right here back in May. You can go back, right? So you can even go further back in July of 2023. This right here, not quite exactly at 4, but 3.9 back in January of 2023. Scroll back a little bit further. The last time before that was in November of 2021, which was right before we started that bear market of 2022. And this was perhaps the most extreme reading that I've been able to find on our MoneyVest index, which was back in April of 2021. We were well over 4.45. I don't think anything crosses above that 4.45 threshold, but we have crossed over 4 several times, which is historically, once again, been a unfavorable risk-reward trade-off in the market. Not saying that this level right over here is an immediate sell signal. It's never been the case. It's really just our understanding of where the risk-reward is, how favorable it is to trade on the long side versus on the short side, because you are looking at volatility at really low levels, just under 16. We are now once again in the 30th percentile with majority of stocks, right? So trading above their 50 SMA, trading above their 200 SMA, and trading above their 20-day SMA. It's almost at 90% of stocks right now trading above their 20 20 SMA with 78% and 76% respectively, trading above their 50 and 200 simple moving average. Now, this right here is perhaps one of the most important leading indicators for the market's positioning as well, which is the PCC index. That's the put call ratio. And the moment this crosses over 1, I've triggered this as a green color code because there are now more puts in the market than there are calls for S&P 500 based on the options chain. And what that really tells us is hedge funds, institutional investors, big money, the whales, are hedging for a potential downside. That's why they're buying more puts than calls, because they are expecting some downside move. And it's usually times like these when markets are ripping to all-time highs and they're pretty much trading near all-time highs is when put prices are really, really cheap. So it makes a lot of sense for a lot of these hedge funds to protect for that downside. It's kind of like an insurance policy for them. So that's one of the ways that they hedge their portfolio. How? Because they're mostly net long, right? So they're mostly net long biased traders or investors. So really what they're doing is they're not looking to sell out of their positions in an anticipation of a crash or a pullback. What they really like to do is hold on to their long-term positions. And since put premiums are so cheap, they're so low, it's like a really cheap insurance policy that they can buy. And as a result, they're protected in case of any potential downside, right? So they really just make money both ways. As markets continue to move higher, that's great. If the markets does go through these cycles of pullbacks and corrections, at least they have those puts in place for hedging for that potential downside. RSI also getting up to almost 62. So we are approaching a 71st percentile on the RSI. So some of these, numbers are really numbers that have been coded from historical analysis with colors to better understand the overall market's technical and a little bit of fundamental understanding as well. Valuation wise, as I've already mentioned, we're trading up to over 22 now, almost in the 90th percentile. And this right here is the visual representation of those market breadth indicators. So S&P 500 stocks trading above their 20-day SMA, 50-day SMA, and 200 SMA. So what you'll notice is only one of them is already approaching up to 90%. That's the 20 simple moving average, which is also a little bit of a shorter time frame, shorter moving average. And that's why the short-term trend is incredibly, bullish and overbought. Because once again, if you come take a look at how we've traded in the past, every time we've come up to these levels of 89 to as much as 90, again, that's not been great news from a short-term trend perspective on the market. Again, every single time we've gotten up to this level, we have seen an eventual pullback. Now, nobody knows when that pullback is going to occur, whether that's tomorrow or next week or the week after, but every single time you'll notice that we have seen a reasonable dip in the S&P 500, right? So it should not come as a surprise that this is very normal and of course, very, very common in the markets for us to see a short-term pullback right after this indicator gets up to over 89 to as much as 90%. Now, another few more to watch for is the S&P 500 stocks trading above their 50-day SMA. So we still have a little bit of ways to go. So up to 92% is where I would really start to be more concerned, because that's been the level historically where the markets have become incredibly overbought from a technical perspective. And there's been a lot of broad participation. And also the 200 simple moving average, we still have a lot of ways to go at 94%. Right now, we're only at 76.7%. So again, it's not until here is when I actually start to feel a little bit more concerned about the market from a technical overbought condition. However, on a short-term basis, we are still very, very elevated at the market. But this is also, it's kind of like both of those things, because this indicators can also be looked at from a perspective of a very healthy and uptrending market. But at the same time, it also, kind of tells us to be more cautious and more alert for a potential pullback or a dip or a correction in the market, because every single time we have seen that, right? That's just how the markets move. Now, coming over to this, and this right here is the RSP divided by SPY. So what this really is showing us is the S&P 500 equal weight performance relative to the S&P 500 themselves, right? So this is essentially excluding for the weight that the Magnificent Seven give the S&P 500, and that's what makes the S&P 500 in the first place, is because of the market weighting. But RSP is an equal weighted index, so all the 500 companies get equal weight. Nobody gets special treatment in this particular index or ETF. And you'll notice is that more recently we're starting to see a little bit of outperformance on equal weighted index relative to S&P 500. And some of the instances when we actually did see outperformance, this was back in 2022. This was back during the time when there was a bear market in 2022, and technology was the sector that was selling off the most. There was significant amount of selling pressure in technology, in Mag 7, and during that time, equal weighted index S&P 500 actually outperformed the regular S&P 500. Another instance I can point to is the post-financial crisis recovery. So after 2008, 2009, we actually did witness all the way till 2011 a lot of momentum coming in for other parts of the market, and equal weighted actually did much better in terms of its performance relative to S&P 500. And prior to that was once again during that recovery post dot-com bubble. So really this is post dot-com bubble, this is post financial crisis, and this is post 2022 bear market. Those are the three areas, three times when the equal weighted index has actually done better than the regular S&P 500. So this is also market's way of being more defensive, right? Every time we go through a crisis, markets tend to become a little bit more defensive before moving into riskier assets, which according to them can be technology stocks, Magnificent Seven, and the like. So this is just the market's way of, once again, shifting that position from being risk on to being a little bit more defensive. This has all happened after the crises, just the market's way of telling us that it's not time for us to be long risk at the moment. And this right here, if we again see some type of outperformance, if there is any type of crises or recession, the market's position can shift to being a little bit more defensive. And as a result, it's possible the equal weight index, in other words, other markets and other sectors actually tend to perform much better. Now, there are some concerns. The markets are making a double top resistance here. So this right here can be considered as a double top for S&P 500. So next week's going to be very, very critical, very crucial, whether we're able to successfully break out above this level or if you're able to get rejected and then, of course, start rolling over once again. But there are going to be some support levels that I will highlight that we need to watch very carefully because, we do have some gaps that the S&P may want to fill in as well. So if I zoom in really, really a lot, this right here can be a bit of a gap that the S&P 500 may need to come down and fill in. So that's the gap between those two candles. But we also do have this previous resistance over here that I highlighted in my 30-minute chart, which I'll go over later in the video. So this right here being the 30-minute chart here, you'll notice is acting as a support for the S&P, and we've got another support over here sitting right there. If S&P starts to roll over, if it gets rejected from this double top. But we'll talk about that in just a little bit. And we've also got a very nice support at this 200 simple moving average. So we do break down a little bit from these 200 levels, but right now, more recently, we've come down to perfectly validate this. So we are very much in a nice little uptrend for the market still. So that would still be very much valid for the market at the moment. Now, one more thing I want to point out too is going to be the S&P 500 with respect to the dollar. This right here is going to be the DXY. So in white, you've got the dollar index and how perfectly they both move in opposite directions. You notice the top here, the bottom for the market here. You'll notice the top for the S&P here, the bottom for the dollar here. You'll notice the top for the dollar here, the bottom for the S&P 500 here. And then again, you'll notice the bottom for the dollar index and then the little bit of a top for S&P, a little bit of a top for the dollar, a little bit of bottom for the S&P. This right here has been a significant selling pressure for the dollar index, as you'll notice. We have seen both of them kind of move in tandem with each other because of the unwinding of the trade. But if this were to be, let's say, a bottom for the dollar index, if it were to see a little bit of a recovery back up in terms of the DXY, the dollar index, well, guess what? Historically, those have formed tops in the S&P 500, as you can see over here, as you can see over here as well. And the opposite has also been true, where the dollar index has topped like this, and over here, that's formed bottoms for the S&P 500. So these are some things to really consider because, if you were to kind of isolate the S&P 500 and really try to understand where the dollar index is coming down to, you'll notice that this right here has been a very strong support for DXY. We are actually starting to breach below that support, and there's another one sitting right over there. So this right here is the level from back in July 2023 that the dollar index will be coming down to. So if it does get a bit of a bounce back up, I think it's really important for us to remain careful because that is a double top for the S&P, and if we start to kind of get rejected here, that could be the anticipated move on the S&P 500 if there's any correlation that can be drawn with regards to the dollar index. Now, this right here is, again, the overall trend for the market coming in since the lows from COVID. Very nice validation here at these higher lows. We didn't quite come down to this level, so we didn't quite breach all the way down to this level here. In fact, we got validated a little bit sooner. That's a shorter uptrend for the S&P 500. So it can be, as you can say that this right here is a much nicer, much better uptrend within the context of this higher highs and higher lows. But like I said, we're coming up to its double resistance or double top for the markets as well. And this right here is the index performance, S&P 500 versus the X Magnificent 7 index. So this is S&P 500 X Mag 7. And what you'll notice is that if you take a look at the all-time chart, I mean, it's very clear that S&P 500 has done a little bit poorly coming in since going back as far as January 3rd, 2022. But if you take a look at the last 6 months, it's very clear the S&P has done much better compared to X Magnificent 7. We've seen over an 11% gain for S&P 500 versus X Magnificent 7. All time, really, it's not going back as far as, all time. It's only going back as far as 2022. That's why we don't have all the data. That's why you may see like the X Mag 7 do better because of the 2022 sell-off and what I mentioned for the equal weighted index outperforming during that time. But if you take a look at year to date, S&P is still up well over 15%. Almost 20% actually, a little bit over 19, almost 20%. And when you exclude from Magnificent 7, the gains are only 15%. But the interesting observation here is the last 1 month. What's really happened in the last 1 month here is that shift has happened again as the X Mag is up over 2.4 versus S&P up 1.5. Once again, market's way of telling us that we are getting a bit more defensive. Not a big move, not a big divergence, so to speak, but still something to keep in mind because these are very important hints. These are very subtle indicators for us to also understand about the market. Now, coming over to S&P over here, this is the overall trend. This is what we were talking about in our previous weekend video, where I mentioned that we are still well within the context of this lower high and lower low. We got up to this level, broke out of that resistance, so that lower high and lower low was broken, and then broke out of this previous resistance, came back down to retest that old resistance as a support, and now we're moving back higher. So S&P 500 on the 30-minute time frame has got a big challenge in front of it, and that is two things. Number one, hold this support. So the bulls going into next week need to hold this level. If this level gets broken out, or if this level gets taken out from the bears, then it's possible that we start to rotate back down. And I wouldn't be surprised if we actually start to trade back down to 5,400. That's a level that is possible if bears essentially take this 55, 65 level out and the bulls are not able to hold it. So this right here for the bulls, very important level. Now, in terms of resistance, we're pretty much waiting for all-time highs. So that is going to be that level, 56.67, 56.69 to be precise is going to be that all-time high level for the S&P 500. So that's a target to keep in mind, combined, of course, with that previous all-time high and a little bit of resistance now sitting roughly, I would say, around here, because for the last couple of days, we're unable to break above 56.40. So those are a couple levels to keep in mind going into next week. Got a very strong support sitting at 55.65, which the bulls need to continue to hold up. Now coming over to Apple stock, I'm going to very quickly go over Magnificent 7 here. Apple also starting to consolidate sideways for the most part. So what we're really witnessing from Apple is just a lot of consolidation here in this range for Apple. That's going to be sitting roughly between 223 to as much as 228. And that's been the overall consolidation. People can argue that this is a little bit of a bull flag where you've got a pull over here, you've got a potential flag forming, and that's going to lead to another breakout. For Apple, it's also got its September 10th event for the new iPhone and the new product launch. So that right there is going to be that next target resistance. And we are also on the daily time frame sitting at, I would say, a little bit more elevated than usual on the RSI and the MACD. So if it does end up, let's say, breaking out, next resistance, all-time high 236, support level at $207. Amazon, on the other hand, is also starting to roll over a little bit. 173 is going to be that support. Of course, we gap down quite aggressively, all the way down to 151, and the next target and resistance pretty much sits at roughly at 189 to 190, support level at close to $173 for Amazon moving forward. Now moving over to Tesla, and Tesla, again, I've done a video on Tesla more recently, so make sure that you do check that out. Well within the context of this downtrend still, so lower highs and lower lows, and support level is going to stay put roughly at around $208, $209, with their resistance all the way up to $233 a share. So that right there is going to be that level to keep in mind. It's got a lot of areas of supply and a lot of areas of resistance that it needs to break out of. That's why I've been selling covered calls on Tesla and also selling puts on Tesla because it's one of the most profitable ways to generate some cash flow because of so much volatility on Tesla as what we have witnessed for this company. Coming over to NVIDIA now. So NVIDIA also, I did a video more recently, just about 14 hours ago. Big earnings coming up for NVIDIA. So that's going to be very important for us. Resistance all the way up to as much as $139, with the support level staying put roughly at around $119, $120 a share for NVIDIA at the moment. Well within this higher high and higher low pattern for NVIDIA at the moment. And finally, if you go over to Meta, Google, and Microsoft, and you'll notice Meta here trading pretty much at all-time highs, but coming up to its resistance. And the reason why I'm going over these Magnificent Seven more specifically is because they actually do end up moving the markets a lot more than anybody would think, because they are the ones that are, over 30% of the index. So that's why where Magnificent Seven goes is where the market goes, right? I don't care about anybody. I don't care about what anyone else says, but this has been true for a very long time. Even if we can get that momentum from other parts of the market, it's not going to be enough for us to see that momentum for aggregate indexes to move higher unless these companies carry their weight. And that's why they're so important to the entire market. So Meta, for example, trading up to its resistance pretty much at all-time highs, support level all the way down to $460, down to inside this green rectangle sitting at $415 for S&P for Meta here. And finally, going over to Google and Microsoft. Now, Google and Microsoft actually underperformed significantly. I do also think that Google is making a little bit of a bear flag. It's trading right at that support here. So that's going to be the level to keep in mind for Google going into next week at 166, down to as low as 150s for Google. And then finally, if you come over to Microsoft, you'll notice this right here is the potential head and shoulders for Microsoft. Very much of a left shoulder, head, and a right shoulder with a very strong support and neckline sitting roughly at $400 per share for Microsoft moving forward. Resistance is going to stay put at $430. So hope you all enjoyed this video and a complete update on the markets from a technical standpoint. Make sure that you drop a like and subscribe to the channel. Let me know your thoughts down in the comment section below. And as always, happy investing. I'll see you all in the next video.